their thing is right. Their opinion is different, whereas we, whereas the private organizations, their opinion is different. And second one is provision of depreciation and depreciation policies. So depreciation policy, right? Depreciation amount a company cannot pay to anyone. These they are creating depreciation provisions after this expected life. See, instead of old mission, the company will buy the new mission. But before that, then whatever this period, 9 years period, 10 years period, how these can be utilized, right? Third one is declaration of dividend and dividend policy. So how to declare the dividend? How much percent is required? For example, the company has 100 rupees profit. 100 rupees profit is there, 100 rupees what we call EPS, earning per share. Earning per share. So the company has the option either the total amount can be distributed to shareholders through dividend, or company has take 50% of retain, 50% is distribute. Right? Out of 100 rupees profit, they can distribute total amount to its shareholder. It's option A. Option B is 50%, 50%. 50% amount can be using for expansion of the business organization, entering new branches, new vertical growth, horizontal growth, right? Adding new products, same line. Like how they can utilize this profit, declaration of dividend and dividend policy. Which policy they are adopted? As they can say that surplus is 30, the company can distribute 70. Or company say that we won't distribute anything, the total amount utilizing for expansion of business and increasing the business model. So it is different for this organization to organization, management to management, and the size of the organization also differ. Next, retained earnings are flocking back of profits, self-financing. So self-financing, but whatever the profits are there, right? At the end of meeting all the expenditures, and after payment of dividend, dividend of preference shareholders, interest to the debenture holders, tax, the final amount, whatever this EPS, earning per share, right? So these earning per share, either the company can distribute or retain. So here the point is retain earnings. So whatever earnings are there, earnings are retaining. So these amount are utilizing for enhancing the business activities, entering new segments, adding new products, right? Like these profits are utilizing. Most of the companies are focusing on this retained earnings rather than the distribution of dividends. Right? How about the determinants of profit? So the profit is right? Profit is a barometer. If the company get a profit, it's a one kind of it's a successful. It's a barometer. Right? It is a measurement for correcting the financial shareholders, declaration of dividend amount, trend of earning the profit and the stating point, ascertainment of the operating efficiency of the company. So profit is indicating the company operating efficiency of the company. And the profit are deciding the future expansion of the growth. See that this company has a good profit. It indicates that in future also company is chances for expansion their operations and increasing the growth more than 12%, 15%, 80%. Right? How we can say that based on this company performance? How we can say that companies performed well or not? It's based on the profit, right? If the profits are good, if the sales are first point is sales are good. Right? What we call generally the stock market people say that the top line growth. Sales growth is called as a top line growth. The profit growth is called as a bottom line growth. Bottom line growth. Right? So company wants both top line growth and bottom line growth. If the both are good, say that the company is performing well and ascertaining the intensive use of the capital. If the company is utilizing the capital perfectly and efficiently and construct good capital structure, all these, naturally the profit is also increased. So determine the credit worthiness of the firm. So it is also say that credit worthiness means if the company getting good profits, anyone come to give a loan. See that the banker ready to give the loan. Why? Because the company is less risky and more safe investment. And because the reason the banker also ready to give this loan to the profit-oriented companies. The payment of correct taxes. The profit, if you know the company know the profit, then the payment of correct taxes fulfilling all the legal requirements. So determining the basis of mergers and amalgamation of the firm also, the only thing is the profits. The ascertain the importance of industry is as a nation. If the companies are performing well, good profit, it also adding the employment generation, payment of taxes, money circulation, all are under this national economies. What are the sources of profit? First profit is generally is income from business. Income from business. So income from business nothing but is operating profit of the firm. Operating profit of the firm. See that the cement company getting the profit through selling of the cements. Paint company getting the profit through selling of these paints. Entertainment company they're selling this entertainment, providing entertainment to these customers is called as a business profits. But whereas income from other sources which may align the main object of the firm, so income from the as subsidiary sources and show separately prepare the income statement, the other sources of the firm, right? But the focus, the major thing is income from business, income from investments. If the company has a good reserves, good surplus amount, right? So what they can do is the company can invest some other company stocks or government securities, bonds, debentures, right? The company is investing in subsidiary companies or the company investing emerging companies also. Nowadays, we talk about AI-based companies, right? The future is AI-based. Then the company also investing other companies. So this is the scope of the profit. And after that, surplus and the meaning and importance surplus. So surplus, in simple words, surplus may be described as the net income of the company remaining after payment of dividend, all other expenses. So it is different between book value of the assets and the sum of liabilities and capital, right? Whatever this book values and assets and some values of these assets, right? So kinds of surplus, see that earning surpluses, capital surpluses, right? So like how we can use, the company can use these surpluses, but various uses, earned uses, see that reducing the value of fixed and working capital, equalization of rate, all these they are using for various purpose of surpluses. So manufacturing of surpluses, if the company using that, and method surpluses is only theoretical part. Okay, and we move to next unit. It is called dividend decisions, and various topics are there. We'll cover this. So theoretical. This is the total theoretical part chapter, and the next chapter will move to this dividend decisions. Okay, Kalyan garu, I will go through the next topic. This is purely theoretical parts.
Okay.
Dividend theories, right? Like in capital budgeting theories, NI theory, NOI theory, the topic was covered in last class. Now the dividend theories are there. The dividend theories are broadly classified into relevant theories and irrelevant theories. Right? So relevant theory means what? There is a relationship between dividend decisions to value of the firm. There are two decision models are there, Wter and Gordon model under relevance theories. Dividends are uncertainty. The bird in hand argument is one, and second thing is irrelevant. Miller model is also there. So we'll go through one by one. So theories of dividend, there are two theories, relevant theories and irrelevance. Relevance of dividend, irrelevance of dividend. Under irrelevance, again the two models are there. One is Wter model, second one is Gordon model. Irrelevance of dividends, it's under the approach, Miller approach. So we'll go to one by one. First, we'll move to this Wter's model. So Professor James Wter has developed the theoretical model, which is the relationship between dividend policy and common stock prices. Common stocks prices nothing but equity stocks prices, equity share prices. There is a relationship between dividend policy and common stocks. The basic premise underlying this formulation is that the prices reflect the present value of expected dividend of the long term. So if the company paying the dividend is any impact the market price of the share. If the company is not paying any dividend, is any impact is there. So this Wter says that there is a relationship between dividend decision, dividend policy, and the common stocks, right? And the real also ONGC, as I told earlier, ONGC, IOC, HAL, all the public sector organizations, public sector units, PSUs, are paying dividend to these shareholders. At the same time, they're also paying dividend to this government also. That is the reason we can't expect much growth the dividend payment organizations. But whereas the private organizations, private companies like Reliance Industries, Infosys, TCS, most of the companies, they won't pay any dividends. So whatever the surplus amount is there, these surplus amount are using for the company growth. Company growth. If the company is growing, number of branches are increases, naturally the size of the business increases, the value of the share is also increases. So here the Wter says that there is a relationship between dividend decision and common stock prices. So in his model, there are some assumptions are there. The assumptions are the firm finance all investment through retained earnings. The debt or new equity share is not issued, right? You see that the company, whatever the profits are there, these profits are is impacting or not, right? For example, the company wants to start a new business, it requires 100 crores rupees. 100 crores. Okay. New business. Or they want to expand their operations, some other 10 branches, they require 100 crore rupees. This is the company requirements. Requirements. The company has so many options are there. One is the company can issue preference shares, company can issue equity shares, right? Company can issue preference share, equity shares, debenture also. And fourth one is either going for, instead of issuing all these, the company using for these profits. Which one is better, Kalan Garu? Can the company can either issue preference share, debentures, or they can utilize the profit amounts? Hello?
Sir, debenture, debenture.
Okay, debenture. See that the company profits are utilizing. Why? Because if the debentures issued, the company has to pay a fixed percentage of interest.
Okay.
Equity shareholder, they need to pay them. But whereas the profit, the company has no obligation to pay any interest, right? So any interest, any interest. So that is one of these major advantage, right? Here the firm's internal rate of return IRR and cost of capital are constant. So that is KO and return is both are constant. All earnings are either distributed or reinvested internally. They are all distributed or reinvested. Okay. So here they give the formula for knowing this. The firm is a very long term or infinite life. It is a perpetual firm. Every firm is a perpetual only. So no one can start the business for only 2 years, 3 years, correct? So everyone says that the company can run more than 100 years, 200 years. It's lifelong expectations, right? So here the life price of the market common stocks is equal to D plus T nothing but dividend per share and R nothing but return on investments and K nothing but cost of capital, E minus D. E nothing but EPS minus dividend distribution, right? Here you can see that the EPS we calculated 100 rupees. How much amount the company going to pay in the form of dividend? Right? For example, the company is paying today dividend 50 rupees. What it means, 50 rupees are retaining, 50 rupees are distributing. Okay. So in this case, how this impacted, how this company is impacted using the formula, we easily calculate the Wter's model. Right? The present value of the infinite stream of the constant is D by K.
Okay.
D by, this is called the KO. Okay, this is by KO. So like as per his model, as per Wter, he are segregating all forms are three categories: growth form, normal form, decline form. So he said that growth form return is higher than the cost. R is greater than this K. Okay, return is greater than the cost. So if the firm have the return is greater than the cost, it may be referred as a growth firm. So growth firm are assumed to be have uh, amply to profitable investment opportunity. These firm naturally can earn a return which is more than investor expected. So this firm they suggested is the whatever the amounts are, total amount is retained. The optimum payout ratio should the firm is 0. So if the firm is growth firm, no need to pay the firm no need to pay any dividend. He said that like this. Growth firm gets advantages of not issuing this dividend. Whereas the normal firm R is equal to K. So this firm, the payout ratio is optimum. Either there is no much difference. Either you can pay dividend or you can retention. There is no much difference. Why it's not much difference? Because R is equal to K. Expected return is equal to cost of capital. Both are the same. So there is no much impact in this normal form. Decline form. So decline form here is see that return is lesser than the cost. So this form is said that the company can total amount retain. First one is zero retention. Retention is 100%. Distribution is 0. So this is one. Here that declining form 100% distributed. Whatever the total amount the company are generate the profit, the total amount either distribute or retain. So how we can say that based on this, each form is growth form, or each form is a normal form, or each form is a decline form. If the growth form is say that we suggested don't distribute the profits, whatever the total profit are retained for growth forms. If it is a declining form, the way suggested is that there is no much difference either you are issuing the debenture or not, and there is no much influence of the company share price, market share price. Decline form, we suggested investors are expecting 20% return, but whereas the company providing only 12% return. So in this case, the companies are better to distribute the dividend. Okay, am I clear, Kalangaru? The total firms are categorized into three: growth model, normal form, and decline form. The next one is under Wter's model, we are going to calculate one problem. So this is given in the coming examination also. From the following information supplied to you, determine theoretical market value of equity share, using Wter's model. Here see that earning per share, earnings of the company 5 lakhs. The total earnings after meeting all these preference dividend, debentures, interest, and tax rate, the amount company earnings are 5 lakhs. Dividend paid 3 lakhs rupees. Right? Dividend paid 3 lakhs rupees. And number of shares outstanding 1 lakh shares means the company is issued 1 lakh its shares. PE ratio, price earning ratio is 8. Price earning ratio is 8. Then rate of return investment is 15%. 15%. So now we can calculate the simple applying that D is a 3 rupees. How we get the 3 rupees? The dividend paid 3 lakhs divided by 1 lakh. We'll get 3 rupees plus D plus okay R by KE. R is required rate of return is return on investment is 15%, and 12.5% is what we call KE, cost of equity is 12%. Okay, 12% cost of equity is 12%. Then using this formula of 5 minus 3, so it is 42.3 paise. 43.2 paise is there as per this Wter's model and the dividend decisions. Okay, so like you can see that similar problem in this case. Just I read it. I will read a problem. A company earned rupees 5 per share, that is EPS per share, is capitalized at a rate of 10% and has a rate of return on investment 18%. Here you can see that the cost is 10%, and return on investment is 18%. Right. So this is R greater than K. So this form is called growth form. So what our conclusion is, growth form don't pay any dividend. According to Wter's model, what should be the price per share at 25% dividend payout ratio? Means whatever the profit is there, out of 3 profit, 25% is payment, 20% is retained. So is this optimum payout ratio according to Wter's model? So we apply the formula R, P is equal to pricing per share is equal to D plus R by KE into E minus D. E minus D. So here the dividend is 12.5%. Sorry. So it is dividend is 12.5% and 18 by 10%. These percent is taken here. And again it is 10% and the 50 minus 1.25. So like the firm is getting 80 rupees profit. So it is called R is equal to R greater than KE. R greater than KE. Okay. So this is the one method using calculating the Wter's model. Wter's model we can calculate using this dividend policies. Next one is we move to garden approach. Garden approach is also related to dividend theory only. So again, one more problem here. You can go through your material. Next, garden. So garden says that is another relevant theory, garden method. So here some assumption. The firm is all equity firms. There is no debt. I mean the company not taking any advantage. The total, whatever the amount required, they are issued this equity share. So like the first assumption is all are equity firms. The second one is there is no outstanding finance. All investments are financed exclusively by returns. There is no excluding finance. Company doesn't have external sources. Just whatever the profits are, these profits are utilizing for investment purpose. IRR, internal rate of return of the firm remain constant. R remain constant. K is also remain of the firm regarding the is also same. The firms derives its earnings in perpetuity. So like that, R is equal to greater than G. So we can apply the formula. It is very simple formula. It is very simple formula also. Right? Here E into 1 minus B. So price of share is equal to price of share is equal to E into 1 minus B. So 1 minus B nothing but dividend payout ratio. B is retention ratio. E is equal to earning per share. 1 minus B nothing but out of how much amount company is going to pay its amount in terms of dividend. How much amount the company is going for payment of dividend. That is equal to 1 minus KB. KE minus BR. KE nothing but cost of equity. B into R. So this is the B into R. PBR. Next, we'll see that this is the here say that R is equal to greater than 0, R equal to KE, R less than to KE. So like he suggests that the firm is also similar to have 3 different models. There are so many models that the 3 models are very popular. Then we'll see the one problem are using this method. Right. So determine the market price of share of LMN Limited. LMN Limited. So KE is 11%, E is 20%, I is equal to 12%. right? I is equal to I, right? So here you can see the apply the formula P into E into 1 minus D by KE minus PR. So here you can see that individually R is equal to 12%, R is equal to 12%. And see that here R is equal to 12%. B is equal to how much? B is equal to, here B is given. No, we can't find out any. B.
B is the 90%.
Sorry? 30%, right?
Yes, C 30%, B 30%.
Yes, correct. Okay. We can see that here there are three different scenarios are given. The first one is market price of the share if dividend payout ratio is 90% or 60% or 30%. Three different scenarios, but the market price, right? If it is R is 12%, growth rate is 12%. Here B is 90%, nothing but it is this amount. Then the value of market price per share is 100 rupees per share. Whereas B is 60, you can see it is, I think it is 100. It is 210 rupees. Now it is 182, 189 rupees. Three different scenarios. Now we can see here R is equal to 11 means return is reducing. R is 10%. Like we'll take an example, various return what we call payment ratios, dividend amounts. We know that the impact is there or not. Okay. The impact of dividend growth model can be easily analyzed in three different scenarios. The first one is when the normal capital rate is lesser than the actual capitalization rates. So normal capitalization lesser than this actual capitalization rate in situation, the shareholders gains more earnings by investing in a company that expect as a normal company. The shareholders would want to the firm to retain more than to pay as dividend. So it's a growth firm, it's a normal firm. It can be like that the company either dividend distribute or retain. Right? Dividends and uncertainty, the bird in hand. Right? So here any business, there is a risk is involving. The business risk, at the same time, we talked about investors' point of view risk. They are expecting the price rates are going up. But sometimes the result is opposite. Instead of increasing the share price, it may be decreases. But various reasons, sometimes the company growth, company profits, company sales, company promoters, like various reasons, it also influences investors are risk averse. They put a premium on certain return on dividend, penalize uncertainty of risk. So bird in hand, right? So here the bird in hand concept is better to avoiding the risk. Risk can be avoided, uncertainty we can't be avoid, we can't be handled. Next one is dividend models under irrelevance model. Means dividend policy, there is no influence in the market price. The market price increases as per this modeling article. So he said that the dividend policy, the growth, valuation of the share, he suggested there is no link. Either you can pay dividend or may not pay. There is no influence. He said that, right? He conclude that MM model based on certain assumption, which slightly importance of dividend policy and its effect thereof on the share prices. So his assumptions are the markets are perfect markets, right? So no individual can influence the market price of the share, but some people can influence, like RBI governor. If RBI governor can give the information, definitely market influence, right? But naturally, see that most of these markets are perfect market. No one can influence. Investors behave as rationally. Information is freely available to everyone. Transaction costs are nil, but it's not true that there is a transaction cost is there. Securities are divisible into in number of investors can influence the market. price of the share. Okay. So there are no taxes, but without taxes, there is no transaction. This is also not very near in the market. The firm has fixed investment policy, which will not change. So this is also there. He said that PO is equal to current market price per share is equal to 1/1 plus R. R, nothing but naturally we can use growth, capitalization rates. So D1 plus T1. So D1 is dividend per share at time 1 and expected market price per share. See that these MM say that if the company won't pay any dividend, they won't pay any dividend, right? But the investor assume that the market price move will move or not. See that the example is there. For example, ABC company is there. ABC company name. Current market price 100 rupees. 100 rupees. Company EPS, earning per share, it is 10 rupees. Right. The company's options either distribute or retain. He said that, as per MM says that, if the company declare the dividend, the market price is no change 100 only. If the company won't pay dividend, so the amount is retained, then he says that the market price move to 110. Instead of 100 rupees, it is 110 rupees. Right? If the distribute dividend is 100, if the own dividend is 110 rupees. So it's only psychological method. Most of the people say that there is no link, but in practice, there is a link between dividend policy and value of the firm. So here he says that Harish Engineering Company has a cost of capital is 15%. It is a cost. 15%. The current market value of the firm is 60 lakhs rupees, 30 lakhs rupees, 30 rupees per share. Okay. And assume value of new investments, rupees 18 lakhs rupees. Earnings are 10 lakhs rupees. The total dividend is 6 lakhs rupees. So here, like this company is there, you are required to show that under the MM assumption, the payment of dividend does not affect the value of the firm. We'll using the same formula. So 30 rupees per share plus 3 plus T1, we don't know P1. Then we calculated this is 31.50. Okay, 31.50. So like here, very simple problem also given. R is equal to 0.12, growth is equal to. So P0 is equal to 10 rupees, D1 is equal to 40 rupees, 40%, and outstanding shares are 5 lakhs. Right? Just you can apply the formula. So 10 rupees plus 1 minus R minus D1 is equal to P1. See the value is, the company value is including the number of shares outstanding this much. Right? So, however, the unrealistic assumptions of MM hypothesis render the hypothetical unrealistic and insignificant manner is also there. It is so far away to the present market conditions. Okay, so like that in different decisions, either we can expect one problem in the examination, main examinations also. Either you can calculate the market price per share using the relevant model or irrelevant model, or sometimes the examiner directly mentioning that. So you can calculate the impact in the dividends in the stock market price under Wter's model or Gordon model, or you need to prove MM model also. Okay, so like there are 3 models under dividend decisions. Now we move to dividend policies. Okay, right? Dividend policies. Right? Dividend policies. 13 unit dividend policies. So once a company can make a profit, it must decide what to do with the profits, with these profits. So naturally, most of the companies, Kalendar, what they can do is, whatever the profits are, what they can do with the profits?
Expand the companies. They're using
most of the cases, they can expand their operations, expand their branches, entering new products, introducing the new market, right? They enter new markets, right? Yes. So they should continue to retain the profits within the company, or they could pay out the profits to the owners of the firm in the form of dividends. But most of the government companies, they prefer payment of dividend. That is the reason we can't see the growth. We can't grow in the public sector units. Where the private sector organizations, the growth is higher than this. Why is higher than? They are into new market, introducing new products, right? They are taking advantages of dividend profits on profit side, right? Dividends are major cash outlay of many corporations. This is one more dangerous if the company declare that if the company pay the amounts. If the company pay the amount, one more major problem is this thing. The cash, whatever the cash is, the firm is outflow of the cash. The company facing a problem is liquidity problem also. The company is also facing a problem, liquidity problem. At first glance, it would appear that the company would distribute as much as possible to please its shareholder. Earlier concept is there. First priority, they give this dividend to the shareholders. But later companies, they are not focusing on the payment of dividend, right? So dividend definitions are, the dividends are those companies expect to maintain pay off yearly, sometime monthly, quarterly. So regularly the company paying every 6 months. Well, naturally the companies are paying them year-wise. Extra dividend are those that may not be repeated. So extra dividend also companies, if the company performing well, the company profits are good, they are paying extra dividend also. Special dividends are those which are unlikely to be repeated. So special occasions dividend also paid. The stock dividends, nothing but bonus shares. The stock dividends are someone paid to the share, paid in shares of stock. Similarly, stock splitting, both increase the number of the shares outstanding and reducing the stock prices. Most of the cases, the top companies, they are splitting the stock prices. Why they are splitting the stock prices? See that one company, right? 1 lakh rupees MRF share price is there. MRF share price is 100. Just I will check 1 minute. Kalyan, I will show you this screen. Right. Now my new screen, right?
Yes, sir.
So just I show you this MRF company trend. See that MRF company market cap is 45,690 crores. Okay. The current price share is 1,07,760 rupees. One company share, each share value is 1,07,000. This is the first company having this highest value. No Indian company having this more than 1 lakh rupees share value.
Okay.
So 1,07,000 share, right? PE ratio, profit earning ratio 37%, ROCE, return on capital employed this much, 7.43%. Return on equity this much. So face value, you can see the face value, how much it is. Face value is
10 rupees.
See the current market price.
1 lakh.
Yeah, how many times? Right? How many times it says increase the face value to this, right? We can see the company 1 month, you can see the company max, see the company price rate. So in the year 2005, the share price is 2,912 rupees. I think you're seeing the graph, right?
Yes, sir.
How much it is? 2,000?
912 rupees, 0.7.
Yes. Now we can see here peak price.
1,07,000.
Highest price. 1,07,760, right? Right. The span of, I think it span of 13 years, right?
13 years.
13 years. How many times the price? How many times it be returned?
17 years.
See this, right? You can see this. It's a peer group, similar group. See other companies. Balakrishna Industries, see the market cap is much. Apollo Tiles and CH, JK Tiles and Good Year India. See the competitors.
Yes, sir.
So the competitors, see that competitors were very, no one is near, right?
No, no one is near.
No one is near, but he can see the market cap. Balakrishna Industries are very near. It is higher than actually 46 lakh crore, 46,000 crore. See the dividend yield. So this is the dividend yield is how much it is? 0.16.
6%.
So you have 0.67% is Balakrishna Industries. Right? So see the net profits, quarter net profit this much. The profits also this much. See the sales. See the sales. Apollo Tire is second highest.
Yes, sir.
ROC is also 7. Like so, like you can see this quarterly report, quarterly of MRF ties. Right? See the operating profit and see the way we are earning per share. See the year 2020, earning per share is how much it is? 31 rupees 74. In the June 2020.
Yes.
Now we can see the after 13 years, earning per share is how much? 1,388.20 rupees. See how many times the value is increased. Okay. See here the profit, the sales growth. You can see the sales growth also. Year 9,000 is 23,000 crores. Okay. And cash flows activities and dividend per share. We'll see that. Okay. So tell me any company stock. I will verify it. Any company stock, calendar, any company share. Asian Paint.
Okay, sir. Asian Paints.
Just we'll check Asian Paints. See the Asian Paint, the market cap is 3,03,000 is equivalent to one company, one state capital, right? State budget. 3 lakhs crores.
Yes.
But see the face value is 1 rupee.
1 rupee. Now is 3,000.
Current market price this much. Okay. See the company performance, share price. So earlier it is 39 rupees. Now it is the highest price is 3,590.
590.
Highest price so far. Highest price is lowest price is this much. It is called 52 weeks high, 52 weeks low.
Okay.
52 weeks high, 52 weeks low price value.
Low price.
Okay, and see that price earning ratios and EBITDA and book to price, market cap to sales. Okay, so here market cap and sales. See the market cap is higher than this market cap. Market cap is whatever this market cap is higher than the sales, right?
Yes, sir.
Here see that the sales are limited, but increase this. See the gap here.
Yes, sir.
Because of this up, now you can see the downtrend. But here you can see that the market cap, right? The sales are high, still the market price is low.
Low.
Right? You say that it's a market is a bullish market or bearish market is also very important. See here the market is here you see that before COVID, these effects are there. Okay. This is the COVID period.
Yes, sir.
Because the reason market sales are limited. Okay, and see others also. See the burger market cap is not. No one is very near to the Asian Paints. Nerolac, Indigo, right? All are not this much. The sales you can see that quarter and quarter sales are swinging this much. Okay. So like no organization, dividend payout ratio. See that here, dividend payout ratio. Earlier they paid 39%. Now they paid 60% dividend payout ratio. Right?
Okay.
Out of these 10 rupees 31 paise, they paid 39%. Remaining 61% they are retained.
Okay.
Here 40% paid, 40% on this amount. 11.61 into 40 amount, 40% paid, remaining 60% amount is retained. So we can see that there is no constant in the dividend of the companies. But last year, last March and this March, they are paid more than 60% dividend declared. I mean, they're already market leader. There is no further scope for, they are the market leaders.
Yes.
There is no further scope for doing the things. They are already saturation stage.
Yes.
Because there is a last 3 years, they are paying higher dividend.
Higher dividend.
More than 50%. 50% retained, 50% is
Dividend.
Right? Dividend distribution. You can see the compounded growth TTM, time to time, here 9%, 3 years 5%. The longer period 13% only. Last 3 years 20%. The profit, see 14% profits. Right? Return on equity. So last year 28%. Okay. See the balance sheet. All we can companies balance sheets. Okay. So like we have one more website. It's called Ticker Tape. I will. I think my screen is visible, right? It's a new screen, right?
Yes, sir. Ticker
Yeah.
tape.
Yes. So this is Ticker Tape. This is also one of these popular. Most of the investors watching this app is also there. So you can see that I am entering this SBI stock. I will take this ONGC, government sector organization. Just I will check. Wait a minute. ONGC. ONGC stock. Okay, see the last max period, we'll see max more than 5 years. See the fluctuations of these companies' price rates. Okay. And last 5 years, there is a lot of variation. This is the COVID period.
Okay.
Here you can see the COVID period market is down.
Now,
And I told you that this is regularly paying the dividend to the governments.
okay.
Okay. We can see this. These are the company balance sheets year-wise, year-end sales. So total revenue, nothing but the company sale this much, and year to year. The DPS, you can see here dividend per share. Dividend per share. This is the EPS, earning per share. Out of this, the company paying dividend per share is this much. 5 rupees they are paying. Out of 9 rupees, 8 rupees 50 paise, they are paying. Payout ratio, you can see that 58 paise they are paying. 58% they are paying.
Okay,
58%. Here you can see that 28%. Here 29%. Here the 40%. Here 47%. Right? So most of the public sector dividend, they are paying dividend to this government. The government is asking for pay dividend. Right? So because of that, we can't see the much growth of these company stocks. See this company, see the growth rates. So earlier it is 100 rupees. Now it's 42.15%. But where I compare the private sector organization, the growth very high. But because the major changes, they are not paying dividend regularly. IOC, just we can check IOC also. So you can see that IOC also 51%, 46%, 42%, 13%. See this revenues also not increasing revenues drastically. Right? DPS also paying. Whatever the EPS is a minus here because the COVID is a minus value, but it's 15.71, 18.23, and 7.11, now 7.80, and Whatever they get, it's very nominal amount. But iWorks is a very good company, but still the prices are because of no innovations, no innovation in the product and price. There are various restrictions in the market. Like the various reasons, we can't see that much growth. You can see this Infosys. Infosys also, they won't pay regular dividend. Now they also pay a dividend payout ratio, not more than 50%. Only 1, 2, 3, 4 they're paying dividend payout ratio. Remaining also the amount they are retaining. So first 50 is first 50 they won't pay, but once they reach the highest stage, then they start paying this dividend. But dividends are always paid on the face value. Dividend always paid on this face value of this company stock. We can see this Infosys price range with. So now it 1,388. Right, see this total return of this company 1,150 means 1 rupees. 1 rupees increased to 1,751 rupees for the span of 2002 to 2013, 11 years. 11 years. Okay. Now we move to our topic. Right. So extra dividend, the stock dividend, nothing but the company share paying the dividend, company paying this what we call bonus shares. Okay, company paying this bonus shares. Now, according to this ICAI, Institute of Chartered Accountants of India, the dividend is declared a distribution to shareholders out of profits or reserves available for this purpose. Right? So say that some legal requirements are there as per this Companies Act. So you can't, the company has to some reserve, some percentage of reserve has to manage it. After that, the company has to pay. So like there are various definitions are there, like various forms of dividends also there. One is cash dividend. The dividend is paid in terms of cash. Cash is outflow of cash. Second one is bond dividend, stock dividend, property dividend. Stock dividend, nothing but the company is paying bonus shares. The company won't pay any dividend. The cash is not outflow. So instead of giving the cash, the company giving this stocks, equity stocks are giving in the form of bonus shares. Those have the 10 stocks, the company may issue 1 bonus shares. The investors earlier, they have 10 stocks. Now they have 11 stocks. 1 stocks. Suppose company say that those people having the 5 stocks, we are receiving 1 stock. So 5 plus 1, the investor having this 5 plus 1 stock, 6 stocks. But company point of view, volume is increased. The bond stocks, the company's company has, it's also known as script bond, script dividend. So company wants to pay dividend, but they don't have any cash, or they want to not maintain the proper liquidity proper thing. Then they can do is they can issue the bond, and in mentioning that the period of the bond 5 years, 10 years, 15 years. After the maturity period, the company paying this dividend. So it is called bond dividend. Postponement of dividend is called bond dividend. Postponing. Proper dividend, some companies can say instead of paying this dividend in terms of cash or stock dividend, a property dividend can be either include shares of a subsidiary company or physical assets such as inventories that the company, like the Apple company can give the Apple watches the company shareholders. Instead of giving the dividend, they can give these Apple phones, and Apple phones equal to market price. Then the property dividend, right? Our dividend is recorded at the market price value of the asset, provided all these, right? So dividend decisions taken by this board of directors of the company. And object of financial management is wealth maximization with shareholders, right? If providing the company has sufficient financing, they can increase it. So here you can see that free cash flow to equity, how the firm can move this condition. ROE, return on equity, is higher than the cost of equity. Now, ROE, return on equity, return is higher than the cost. What happened here? The good projects, cash flow surplus, no change. But good projects decrease dividend, invest in what we call projects. Right? And ROE is lesser than the cost of capital. The project is not good. Why? Because the cost is very high. And cash flow surplus, here decrease dividends, reduce investments. So no, return is very less than the cost. So investment will naturally be reduced, and poor project cash flows deficit, decrease in dividend is also there. Okay. And dividend payment procedures, how we can dividend can pay. First, declaration date, record date, payment date, accumulative dividend, and ex dividend. So declaration, this date is date which the board of directors have declared the payment of a dividend date. Date of recorded means see that the stocks are trading every day, right? Every day stocks are traded, and some people are buying, some people are selling. But they fix date of recording. So in particular date, those are recorded in the stock register, then only eligible for getting this dividend. This is a day on which all persons, those names are recorded in the stockholders, will receive the dividend. Okay. Payment dates, the payment check and mail the shareholder record, come dividend, and this is the last say on which the buyer has. So who buy the stock in entitled dividend, like this. Dividend policies also there, various dividend policies. And factors are determining the dividend policy are various factors are there. The company may go for dividend payout, stable dividend rate, stable dividend, or company has to go for legal requirements. As I told earlier, the companies are they have to maintain some legal construction, contractual and internal constraints like SEBI guidances, Companies Act, the Banking Regulation Act. So, like various entities has to follow their own legal restrictions before declaring the dividend. Bonus considerations. So, this may include tax status of shareholders and what they are what other side of this investor point of view, the market, capital market conditions and inflations. So if the market is bull market and see that all stocks are performing well, then at that time the company are not issuing the dividend. Right? It depends on market mood. Either bull market, bear market, or any inflation rate, higher inflation rate, hyperinflation rate. So it's also a matter of declare the dividend. Types of dividend policies, regular policies mean the company is paying regular, and second one is stable. So stable means every year the company paying 10%, 10%, 10% dividend. Dividend 90% is retained. Constant dividend per share, DPS is very constant. As earlier we see, DPS is not the constant every year. It is different per year to year, right? In practical, we have seen earlier. And the constant payout ratio, stable repeat dividend policy, all the models are there. And the stable dividend policy, a policy dividend policy is a very smoothing like they are given here. So rationale for stable dividend policy, all that. So legal requirement, all are theoretical part. Now we move to another topic. It is the last one, last block. It is fifth block, working capital management. Under working capital management, we have 18, what we call 1, 2, 3, 4, 3, 5 topics are there, right?
Right.
6, 1, 2, 3, 4,
5.
5. So there are 15 units are there under block 5. But 15 all are under work. First one is working capital management, right? So working capital, every firm has to maintain proper level of working capital. Excess working capital, there is a problem. Deficit working capital, there is a problem. So working capital is required for meeting the day-to-day expenses of the organizations. Like there is a relationship between profitability, liquidity, and operating cycle of the organizations. In COVID period, most of the companies are facing a problem for working capital issue. Products are ready, but no one come to buy your products. So how the company can make payment to the employees, how the company make payment to the all the day-to-day regular expenses, office rent, building rent, salaries. So many expenditures are happening, but no one ready to come buy a product. Right? How a company can overcome these working capital issues? Okay, how we can estimate the working capital in the 15th unit? How a firm can betterly estimating the working capital, right? They need to estimate optimum level of working capital, right? After working capital, the next unit is management of inventory. As I told you, inventory cost is very some of these what we call manufacturing organizations, material cost is 60 to 70%. Sugarcane is inventory for sugar factory. The highest cost is sugarcane cost, sugarcane procurement cost. Asian paints, the highest cost is what we call paint, oil, petrol, diesel, and other lubrication oil. We can see the bakery, the highest cost for atta cost is there, right? You can take any industry, manufacturing industry, 50 to 60% or 60 to 70% cost is inventory cost. How best the company is following, implementing a good inventory policy, right? Is it good inventory policy mean there is no effect in this production process. The company has to buy the inventory at a cheaper rate and good quality. Right? Good quality, cheaper rate. There is no influence this production process also. Right? Next one is management of accounts receivables. Right? How best the company can manage company debtors. As I told you, few businesses are then Kalangar, I will give two examples. One company buying material, buying what we will call buying products on cash, selling on credit. Buying products on cash and selling on credit. It is one company. Right? Second company, buying on credit, selling at cash. So which company is good? Buying a credit and selling a cash or buying a cash and selling a credit?
I think second one is better.
Second one is better, right?
Yes,
see
sir.
that buying on credits.
Yeah.
Right? See the DMart, what they can do is they are buying at credits,
Right.
but they are selling it cash. They're buying it credit and selling it cash.
Right.
That's the reason there is no bad dates of this company. The DMart, they are compromising this profit also. Why? Because they're selling it cash. But some organization, due to the competition and due to this nature, what they can is they buy a cash and selling it credits. They face a problem for this accounts receivables management. Accounts receivable management. Right? See that now I will give the example of one also. So credit card, what they can do is selling cash, right?
Yes, sir.
Right? Some of the organizations, some of services, they are selling it cash, right? Buying it what we call is opposite direction. It's opposite directions. Okay. So under the management of accounts receivables, how the company is maintaining its debtors management. We sell the products, sales are abnormal sales, but cash is negative cash flow. Sometimes it happen. Sales are good, right? Sales are 100 rupees, but don't have any cash in our pockets. The total are we sell at credit.
Right.
And they paid after 90 days. Some people are paying after 120 days.
Yes, sir.
See that the car business, how they can right? Car. They can buy the material, all the inputs on cash, but they're selling it credits. Right? By default, now they have this loan facility or venture capital facilities are there. Now they are converted into credit sales into cash sales. Okay, that is there. And okay, Now, another thing is the last unit, it is cash management. Cash is a king in any business, right? We can take any business, cash is a king, right? Cash has a multiple advantages, but cash is some problem also. Cash doesn't generate any revenue. If you put in ideal cash, it can't generate any revenue. Is it revenue any generating? If you're putting the cash in your almara, you can't get any additional cash, right? The value is depreciated after some time. The value is also depreciated. So, like we have in working capital management, uh, unit number 14. So, the working capital management consists of, according to this Gitman definition, the goal of working capital management is to manage each of current assets and current liabilities in such a way that an acceptable the level of net working capital maintained. Okay, so the working capital include current working capital, current assets, and current liabilities. So see that sometime is various types of working capital also, gross working capital, net working capital. So these working capital policies are also different for organization to organization, nature to nature, time to time. Okay, if the larger size, larger working capital required. Smaller size, so small working capital required. Size of the working capital for a given amount, fixed assets, investment, sale of a risk, return of trade, all this involving working capital financing mix also. Okay, so planning system is also required. So here the operating cycle, how this working capital will move. Part analysis is a significance is important for working capital. And this is the operating cycle. How the cycle will move. So first we have a cash.
Yes.
So what we can do with the cash?
Raw
We'll
material.
buy this raw material.
Raw material.
So raw material we can add labor here. We can add labor, other overheads, and we have a work in progress. Work in progress too, we go for finished goods. So if finished goods, few stocks we sell at cash and few stocks will sell at credit. Suppose 10 goods are there, 10 stocks are there. For example, 10 mobile phones are there, or 10 chairs are there. 100 chairs are there. Out of 100 chairs, 10 chairs we are selling at cash and 90 chairs we are selling at credit. Right? So debtors for 90 chairs. Then we receive the amounts and directly cash will move to like this. But whereas if you sell in credit, we have another step, right? And the 90 chairs will sell on credit basis to the debtors. They will pay after certain period, either whatever the period we mentioned, 90 days, 45 days, 50 days, right? Whatever the period they will pay, then this amount will look like this. If the cycle move very fast, limited, low level of working capital required. If the cycle move very slow, we require high amount of working capital. Right? We know how your question is, how we know that how stock is moving. Okay.
Okay.
As sir said, that time is over, and so okay. So next week maybe I am unavailable due to some out of station.
Okay.
Okay, we'll plan. Okay, Kalyan Garu, thank you so much. Okay, you have any doubt, please. Okay.
Okay.
So this is an overall view of your paper. Okay. So you can reach me at any time whenever you have a doubt and any assistance required. You can call me. I will share my number also.
Sure, sir. I have sir.
Okay. Okay. Right, Andy.